2Q FY25 conference call hosted by Equirus Security. As a reminder, all participant line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinion, and expectation of the company as on date of this call. These statements are not the guarantee of future performance and involve risk and uncertainty that are difficult to predict. I now hand the conference over to Mr. Shripal Doshi. Thank you, and over to you, sir.
Thank you, Nivedita. Good evening, everyone. We have the management of Fedbank Financial Services to discuss the 2Q FY25 quarterly results. The management is represented by Mr. Anil Kothari, MD and CEO, Mr. CV Ganesh, CFO, and Mr. Amit Singh, Head IR. I would not take much time and hand over the call to Mr. Anil Kothari for his opening remarks, post which we can open the floor for question and answer. Over to you, sir.
Thanks, Shripal. Good evening, everybody, and welcome. Thank you for joining the Q2 call to discuss the earnings of Fedfina. Over a year ago, NBFCs were in a Goldilocks kind of situation. This was based on the trifecta of circumstances. One was growth. The second was what was expected to be a declining interest rate environment. And the third was the benign end of the credit cycle. Of these three assumptions, one has played out, which is that growth is there, and the other two haven't played out the way we thought we would. Rates haven't come off over the past year, even though they still hold the promise over the next 6 to 9 months. And the credit environment seems to have materially changed for now. In Fedfina, it was a very busy quarter for us. First up, we've made steady progress on our twin engine strategy. We've seen growth in the quarter. Our AUM grew to 14,220 crores at the end of Q2. This is a growth of 7.8% quarter on quarter. Both our businesses, working capital as well as gold loans, registered smart growth, growing 9 and 8.2% respectively. So growth is there for us. We also invested significantly in our future. We added 46 branches in the quarter gone by. Our presence now is in 665 branches across 18 states and union territories in the country. We've also added about 500 people in the quarter, and we now have 4,743 people at the end of Q2. Finally, we continue to improve our technology, and we fully implemented Salesforce in our small mortgage business, and this is across over 200 branches. All our throughput now is on Salesforce, which we use as a front-end system. We've also made progress in terms of improving our asset quality. This is across buckets. Our 1 plus, 30 plus, and GNPA numbers are better quarter on quarter. Our gross stage 3 is now 1.9%. However, reflecting our view of the environment and feedback from what we see on the ground, we have taken an additional ECL provision of about 22 crore rupees during the quarter. So our ECL, and there on the slide in the deck, is up from 122 crores to 151 crores or so. This reflects our view of the environment over the next few months. Finally, there have been several regulatory kind of vicissitudes over the past 6 months. At Fedfina, we have carefully analyzed whatever we've seen in terms of either circulars, news items, or informal feedback that we get, and continue to benchmark our practices and our policies in light of whatever inputs we receive. So adhering to regulation and ensuring that you stay on top of them is now more than a full-time job, and we confirm that we are entirely in compliance with whatever regulations and informal feedback that has got received from the market. Finally, in Q2, we've received a rating upgrade from CRISIL. We are now rated AA+. So it's across CRISIL, India Ratings and CARE, all the three rating agencies. We have a AA+ rating. We are among the dozen or so NBFCs which have a rating of similar or better. Our profit for the quarter was 64.55 crore rupees. And to take us through to the numbers behind this number and other details of our financials, I'll hand over to CV Ganesh, our CFO. Over to you, Ganesh.
Thank you, Anil. Thank you, everyone, for your participation on the call. The past quarter has been equally momentous for us as was Q1, and we continue to cross new milestones. Our disbursements continue to be elevated at 38 billion rupees, and year on year this represents a 30% growth. For the first time ever, we crossed AUM growth in a quarter of 1,000 crores. Last quarter it had come a tad under 1,000. In quarter two, our AUM grew by 1,030 crores. Which is our highest ever till date. We closed the quarter with the gold loan tonnage of a little under 11 tons, which again is a growth of 2.5 tons year on year. Another milestone we had is that from an average AUM per gold loan branch of 10 crores, we ended the quarter with an average AUM per branch of about 10.3 crores. So these were the milestones. As Anil articulated, we now also have a AA+ from CRISIL from a long-term rating. It positions us well from long-term borrowing because typically for long-term borrowings and bond offerings, people take the lowest of the long-term ratings. And we were a little handicapped there, so this positions us well, given that all the three rating agencies now have us at AA+. On the new origination side, we originated 3,810 crores of loans, of which 1,200 crores was MSME origination across the mortgage and unsecured business loans, and 2,610 crores were gold loan originations. In terms of the P&L, our interest income grew 6% quarter on quarter at 479 crores versus 452 crores in the previous quarter. This also represents a 28% growth year on year. Our net interest income also correspondingly grew 6% quarter on quarter and 28% year on year. Our fee and other income came off a tad higher. So gross income also grew 6% year on year, but 6% quarter on quarter, but 32% year on year. On the expense side, in quarter one, we had guided that we are here for the long term and we will continue to invest in growth. We did that in the current quarter. We commissioned 46 new branches across gold loans and our small ticket mortgage and added incrementally about 400 staff on our rolls. Now these branches take about 12 to 15 months to break even, so there will be a drag in the initial quarters. Because of that and the higher originations, our expenses went up, by about 18 crores quarter on quarter, and consequently our cost to income has also moved up from 55.4 in Q1 to 58.6. From a guidance, we believe that some expenses are good expenses. This is expense which is in the nature of an investment in growth infrastructure. So we do believe that the revenue benefit from this over the coming quarter will offset and bring the cost to income over a period of time to the level we started off in Q1. That being said, on the P&L side, our credit costs moved up 13% quarter on quarter, as Anil articulated. As you would have seen in the sector, especially on the smaller ticket mortgages, we see some stress building up, and we have conservatively taken a PCL overlay on that. We have hiked up our PCR. If you see our SEBI financials which we have uploaded on the exchange, you will see that we have increased the PCR coverage by 250 basis points quarter on quarter. Our PAT came in at 64.5 crores. This compares with a 70.2 crores in quarter one and represents a 8% degrowth. However, on a year-on-year basis, this represents a 12% growth over the 57.8 crore we did in Q2 of 24. Now that being said, I just also want to highlight that our twin engine strategy is working well. Where we have had some headwinds in the MSME business, our gold loans have performed handsomely in both Q1 and Q2. And across Q1 and Q2 in the first half of the year, we have crossed in terms of AUM growth more than what we did in the whole of FY24. On the treasury side, on a quarter-on-quarter basis, our average blended interest cost, we have been able to bring down by 5 bps from 8.78% to 8.73%. On the incremental cost of borrowing, while you would have seen all banks raise their MCLRs, we have actually been able to reduce our incremental cost of borrowing by 5 to 7 bps quarter on quarter. Our current incremental cost of borrowing is a tad under 8.60. Moreover, about 85% of our borrowings are on the floating rate benchmark, which should aid us when interest rates start going south. Roughly 40% of our borrowings are on external linked benchmarks. Incrementally in Q2, 32% of our borrowings were linked to external benchmarks and another 21% were short-term borrowings and resettable on maturity in terms of price. So this positions us well. So this combined with the fact that in Q1 we had guided that 68% of all incremental borrowings were linked to external benchmarks like repo rate, T-bill rate, etc. I think this puts us at the forefront if interest rates, as and when interest rates would go down. Our net worth as on September 30 crossed 2,400 crores. We came in at 2,402 crores. This was up from 2,322 crores in June 24. Our book value per share as of 30th September stands at 64.60. With that, I hand over to the moderator for questions from the audience. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. as soon as someone presses star and 1 to ask questions. The first question is from the line of Ranish from ICICI. Please go ahead, sir.
Yeah, hi, sir. Two, three questions from my side. So first on this, this comment which you made on the small ticket LAP, I mean, stressing small ticket LAP and HL, and hence sort of we have accelerated the provision under ECL. But when I look at the 1+ DPD and 30+ DPD, which fell sequentially, so which lead indicators are you looking at, which suggest that there is a stress building up in this sector?
So I'll tell you how we see it. You look at our provisioning. One of our core tenets is to take up the provisioning on the portfolio. Okay, we used to be at 1.4% at a point in time. Okay, and at the end of the last quarter, we fell to 1.2. Okay, and we decided that we need to take it back up again, and it needs to happen, piecemeal. Okay, so that is one point. The second is that we did achieve good outcomes in the quarter gone by. Okay, but that's the result of intensive activity on the field. Okay, and the signals that we get is that people are finding it a little difficult to come up with their monthly EMIs as opposed to before. So that's the second data point. While one option could have been to just go ahead in light of the fact that the 1+ and 30+ numbers have improved, we've chosen to just take up our provisioning and get to about 1.3% as overall.
No, but
that impact is a 22 crore rupee impact. We've gone from 128.5 to 150.5 crore rupees.
Yes, I mean, just to follow up on that. So, of course, the provision has to be driven by the ECL model, right? So now, when your lead indicators are improving, what parameters are we modifying? I mean, are we increasing PD or are we increasing LGDs to create overlay?
So this is a discretionary management overlay, and as you can see on slide 43, it is across the buckets, across stage 1, stage 2, and stage 3. Okay. Now we do an annual ECL refresh exercise. Okay, typically either in Q3 or Q4 every year. Last year we did it in Q3. The years before that we did it in Q4. And what that exercise will do is to reset the PDs and LGDs in light of our experience over the, in light of our added experience over the previous 12 months. So that input is not yet baked into, what we've done.
Got it. Okay, so last quarter, we sort of highlighted that for the full year, our credit cost will remain, I think, around 80 basis point or so. Now, when I look at the first half credit cost, it is actually more than 1%. So how do you see, that line item trending going ahead?
It's a fair point. Last quarter, I did say that our cost of credit through the year will be about 80 basis points, up from 60 basis points in the year gone by. At this point in time, it looks like it may be a little higher than 80 basis points, okay, given what we are seeing. Now, as a step towards that, we've done a discretionary provisioning this quarter, and maybe we could see 90 basis points or even 100 basis points for the year, entire year. But
right? We cannot, claim to have better data than everybody else, which is why, we will have to acknowledge and take learnings from that data. And part of that is driving our strategy around the credit cost as well.
Got it. And sir, my second question is on the disbursement side, especially in the small ticket LAP NHL, wherein we saw the sequential dip. Is this the reflection of our cautious stance? I mean, since we are seeing the increasing stress in that segment, or how one should look at it?
You're right. It is reflective of our stance. And what we've done is to prioritize portfolio management and collections in some branches over disbursements, and which is the reason we've got the outcomes that we did. So that's the reason for that.
Okay. And would you like to share some more details? I mean, when we say we are seeing the increasing stress, is this, let's say, specific to any pockets, customer segment, or how is it?
So this is reasonably across the board. Yeah. Okay. We are a self-employed customers provider, a small loan provider, and all our customers are in informal businesses.
Right.
Now, post-COVID, there was a pullback in terms of cash flows and businesses coming back and all that. Okay. Now, what we see is that the growth seems to have tapered off for these customers, and their real incomes aren't increasing. The second thing that I hear is that there has been expense inflation across the board. Okay. Informally, the price of oil has gone up from X to Y, the prices of vegetables have gone up, all of those things. So regular, dal pani kind of expenses seem to have increased. That is the second kind of feedback that I'm picking up. Okay.
Okay.
So this is the way it is.
Oh, okay. And maybe if we can just squeeze one last question on the RBI circular dated October 4th, wherein regulator is sort of setting up on carry out lending activities under a single entity. So do you foresee any impact on us due to that? Of course, it's out for a comment. Of course, it's not being notified, etc. But any initial feedback would you like to give?
Yeah. So this you're right, Renish. This is a draft circular, and a similar draft circular came out in November 2020. You may recall. Okay. And about NBFC subsidiaries of private banks. At that point in time, we had written back to the RBI, as I'm sure some other market participants have done, and the circular wasn't. These provisions of that circular weren't implemented. Once again, I'm sure our parent bank, as will other banks, write to the RBI and represent our case. The cut and thrust of what we will say is the fact that NBFCs and banks cater to different target markets. So therefore, a mortgage loan done by a bank and a mortgage loan done by an NBFC are two different products really. You cannot cover them under one umbrella of mortgage loans. Okay? So that will be, what we will, or what our parent bank actually will try and represent. And, we will then see what the RBI has to say. Yeah. So that's our take on it.
And same is the case for gold loan as well?
Now, on gold loan, look, whatever the circular has said, we benchmarked our practices, okay, and we are reasonably in compliance with what is there. On that, there seems to be limited kind of variability.
Yes. Okay. Right. Okay. That's it from my side. Thank you and best of luck.
Thanks so much, Vinish. Thank you.
Thank you for that question, sir. The next question is from the line of Pranav Gupta from AONS Alpha Investor Advisor. Please go ahead, sir.
Hello.
Hi, Pranav.
Yeah, hi. Good afternoon and thanks for the opportunity. A couple of questions. First is in terms of the costs that we incurred this quarter. Obviously, we understand that we have been investing in the distribution, and we've opened about 46 branches this quarter. If you look at our overall guidance for the year, which you mentioned in last quarter, 50 branches on gold and 30 branches on the mortgage side, a large part of that has already sort of been done over this year. Is it fair to assume that incrementally we can see a big dip in costs in the second half? And do we still hold on to our guidance of a 30 to 40 basis points reduction in cost to average assets through this year? That's the first question.
Okay. Yes. In fact, you look at it, your costs get reset in the first quarter. Okay, when you have pay hikes and pay hikes for everybody who works in the organization, and then there is some small increase across the year for any hiring that you may do. Now, the bulk of the increase has happened in Q2 because most of our hiring has happened. We opened 46 of our projected 80 branches. Okay. In Q3, there will be a marginal increase in terms of people cost for the remaining branches that we will open. And the intent is to get done with the branch opening agenda by the end of Q3. Okay. So that is what it is. In terms of cost as a percentage of AUM, it is reasonable that we may get to a 30 basis points kind of improvement across the year. It actually depends on how we see how we pursue growth over the next 2 quarters. The first 2 quarters have been good. We've grown at 40% year-on-year kind of number, and while that's ahead of what we intended for the course of the year, if we don't dramatically slow down, we should be able to get to those numbers.
Right. And just a follow-up question from the previous question on asset quality. If you look at, like you mentioned, there is some pain on the mortgage side. And you mentioned that the reduction that we have seen in other indicators, which is 1 DPD, 30 DPD, is mainly due to the efforts that we have put in terms of collections. But I mean, if you look at gold, right, asset quality has remained stable there, not just for us, but probably at an industry level, with gold prices going up, LTVs, getting better. Is it fair to assume that maybe we are being a little too conservative on the credit cost guidance of 100 basis points, and maybe third quarter sort of surprises us positively, or at least not third quarter, but the year itself?
So the short answer is I hope you're right, but ours is a business of two halves. There's a gold loan business, there's a non-gold loan business. The gold loan business has zero to negligible credit cost, and to the extent that gold loan forms an increasing portion of our on-book or AUF or balance sheet, we are well served. We will not have credit cost on that. Now, on the non-gold loan side, look, there are two components to credit cost. One is what you crystallize, and the second is what you estimate and pursue through ECL. On the latter, it's a function of what your view of the environment is and what the feedback on your portfolio is in terms of PDs and LGDs. Now, for now, I think we should continue to believe we'll be at about 1%, and there's an upside at some point in time, so be it. Yeah. Okay, there's no need to think about it just now, is what I would say.
Right.
I'll just add there, Pranav, that there is internal data and there are external data as well, right? So we have to be cognizant of the external data telling us a story as well, and that's where that's why the commentary. And
the reason I'm asking this is because while on one side, we are talking about some stress being built up, or at least what data we are seeing, but our growth hasn't really eased off in that segment, right? So it's sort of sounding either counterintuitive or us being too cautious. That's the reason I'm asking this question, because our growth has been pretty strong in the mortgage piece as well.
You're right. I think what you should take away is that the management expects 1%, okay? And there has been better 1+, 30+ outcome in the previous quarter. But however, those have been hard won. And I don't think that will change in at least Q3. Okay? And we'll wait for Q4 to happen before we comment on what could happen on Q4.
Right. And in that case, do we envisage some slowdown on the smaller ticket or medium ticket LAP side in terms of growth, as we sort of either tighten standards or take it a little slow? in the second half?
In Q3, definitely, because we, as any organization would, we continually review our practices, see where what kind of borrowers are stressed and all that. So, and we calibrate our approach. So I can say that since we are already almost a month into Q3, it is there'll be a marginal slowing down in the month of in this quarter. And in Q4, depending on what it looks like while we enter Q4, we will be able to guide you.
Yeah, so I'll just maybe supplement what Anil is saying there. See, I think one thing a little different about us is that we are not a single product company. We have 4 products. So if you see the medium ticket, while there has been a slowdown in the small ticket portfolio, if you see our originations in the medium ticket lab, it has gone up 50% quarter on quarter. Right? And the year-on-year growth in that book is 130%. So we have, multiple levers. And we, if we go slow on something, we have the opportunity to go fast on something else.
No,
that gives us confidence in terms of the resilience of the product suite.
Yeah, no, absolutely. Just one last question on the gold loan bit. So we've seen, disbursements come off on a quarter-on-quarter basis. Obviously, last quarter was probably aberration on the upside. And if you see the off-book proportion, that has also come off on a quarter-on-quarter basis. Are we seeing any teething issues on the co-lending partnerships, or is it just a blip in the quarter and then you normalize from here?
So the growth of gold loan is not a concern, and you should not look at disbursements. You should look at the growth in the balance sheet, because the borrowers tend to borrow multiple times, so and repay. So from that standpoint, we are well served. We had a blowout Q1 because of a dramatic increase in the price of gold at that point in time. That is point number 1. Point number 2 is you look at our co-lending volume. It has stayed roughly more or less static over the past quarter or so. That's because our partner banks are also processing all the regulations that the RBI is issuing. As we speak, we are talking to 3 new providers, and we are in the midst of going live, in the process of going live with 3 new partners. And that should happen over the next couple of weeks. Okay, so the hiatus that we've seen over the past quarter is because people are trying to come to grips with the with the altered reality, if any, for them. And otherwise, structurally, I don't see a slowing down of co-lending for gold loan, because the banks are hungry to get as much gold loan as possible, because it's a zero risk weight product for them. So it's an arrangement that works very well for the bank as well as for the NBFC that partner it.
Understood, sir.
Add a little bit more to that commentary. See, in the regulatory context, RBI has been very studied in terms of their approach, and they have been soliciting a lot of data points from various providers. So normally, in such an environment, when all regulated entities are a little unsure, right, and slow, you remove your leg off the accelerator. I think that's only that much to it for Q2.
Understood. And could you just give the amount of tonnage on an absolute basis, if possible? Maybe
we were a little under 11 tons.
QQYY.
So we were a little under 11 tons. 10.7. 10.7 is the number.
And maybe a QQYY comparison, if possible.
QQ was 10.2. So 10.2 June. Last June was 8.6. And 8.3 in last September 23.
Sure, sir. Thank you so much.
Thank you.
Thank you for that question, sir. The next question is from the line of Ganesh Nagasekar from Bharat Bet Research. Go ahead, please.
So my question is regarding the business loan book. So if you look at the average ticket size here, it's gone up quite substantially from say 2.25 million or so to almost 2.8 million or so. Just broadly wanted to understand the reason for this drastic a jump, given that broadly we are a bit cautious on the credit environment. So broadly, how are we looking at the space and incremental lending in this subsector as such?
So our business loans are catered to a segment which is, the prime segment, which means these are customers who have a P&L, balance sheet, tax returns, and everything else. So that is the segment that we cater to. That is point number one. Point number two is that we see that risk ranks by ticket size. Okay, so that is the second thing that we see. In terms of ticket size, our average ticket size for the quarter gone by was 23.4 lakh rupees, which has been constant at least over the past 6 quarters. Q4 23 was 23, 23.1, 24, 24.4, 24.3, 23.2, 23.4. So I'm just reading out data since Q4 23. We are in Q2 25. So for the past 7 quarters, it's been constant. So it's not a change in target segment or something.
Understood. The number on the presentation, so the number on the presentation is 2.86 million. Just wanted to make sense of that number.
One second. Which information, which data?
On slide 41.
Okay. Average ticket size for retail installment loans.
Right, sir.
This includes medium ticket loan against property, small ticket loan against property, as well as business loans, which means it includes all our non-gold businesses. Yeah.
Understood.
There is a medium ticket loan against property business that we have, where the average ticket size is about, 60 lakh rupees. Yeah. So
the bulk of the growth has come in the medium. The bulk of the growth in the ticket size has come in the medium ticket LAP, is it?
Yeah, that's right. See, as I articulated, that has gone up 50%, and originations have gone up 50% quarter on quarter.
Understood.
That's taken up the average at an installment loan level. That's taken up the average ticket size of the book per se. But on the unsecured business loan side, we continue to keep it steady or maybe a little lower than it used to be on a quarter-on-quarter basis. Yeah. And if you see, even the off-book arrangements on there has gone up to 33% in September from 30% in June.
Understood. Got it. That's it from my side, sir.
Thank you, Manish.
Thank you for that question, sir. Ladies and gentlemen, to ask a question, please press star 1 now. The next question is from the line of Manav from individual investor. Please go ahead, sir.
Hello. Sir, can you give your guidance for the ROE and the ROA numbers, because it is continuously decreasing from last 2-3 quarters?
So I'll try to answer that. See, essentially, as you would have seen the sectoral commentary, while all of us would have liked interest rates to go down, interest rates continue to remain at elevated levels. Plus, there is a funding squeeze in terms of bank lending to NBFCs, which is making liabilities costly. Right. So the environment that, combined with the commentary in terms of the increase in collection intensity on the ground and subsequent costs incidental thereto, right, lead us to believe that we may need to downward revise our guidance from what we had given in Q1. As of now, so we had delivered a 2.4% ROA in FY24. I think conservatively, we will at least try to be steady on that for this financial year. Again, every quarter we will revise this. But as of now, looking at how Q1 and Q2 have trended and some of the other indicators, while we have had a robust asset growth, looking at some of the other indicators, it requires us to be a little more conservative in terms of the philosophy.
So ROA in the Q1 you are given that it will be between 2.7 to 2.75. So now you are telling that it will be around 2.5, right?
So we are saying we will try to maintain it at the FY24 level. So FY24
Okay.
was 2.4.
Okay, sir. Thank you so much.
Thank you for that question, sir. The next question is from the line of Sandeep Joshi from Unifi Capital. Please go ahead, sir.
Thanks for the opportunity. So I'm just trying to understand our credit cost guidance. So I guess for the first half we are somewhere about 1.4 to 1.5 level, and I guess for the full financial year we are guided between 90 basis point to 100 basis point. Is that correct?
That's right.
Yeah. So which means that for second half we are building a very minimal credit cost for the second half. So that will be led by resolutions, or can you just speak a little bit on this?
Yeah. So Sandeep, I'll maybe just clarify. So when Anil guided about 100 bps, he meant on the ROA tree basis, not on the AUS basis. If you see on the ROA tree, right, on the ROA basis, I think our credit cost is coming off at a little under 1.3. That I think you should look at that number in terms of that indicator.
Sure, understood. Okay, thanks.
So we believe that we are being, as one of our colleagues on the call said, maybe we are being a little more conservative with what we believe. We would like to be hopeful. So that's where it is.
Sure, fair. Understood. Thank you.
Thank you for that question, sir. The next question is from the line of Renish from ICICI. Please go ahead, sir.
Yeah, hi, sir. Just one question from my side on the growth. So given the situation is, and maybe we are also of the opinion that there is some stress building up in some of the product segments, be it unsecured loan or the small ticket lab segment. So what is the guidance for growth maybe for FY25, and if you would like to share for 26 as well?
So we have 4 businesses, Renish, and let's try and build this growth up elementally, business by business.
Mm-hmm.
Now, as far as gold loan is concerned, it's in a good place. Okay, and the growth will be determined by 2 things over the next 6 months. One, obviously, is the price of gold, which seems to have an upward bias. That is one.
Right.
And the second is the fact that we will have 50 additional branches. Okay, those branches, did not exist or did not deliver in the first half of the year. So the second half of the year, they will be productive. Okay. So that is one. So the gold loan business is in a good place. It is robust. And as soon as the new co-lending arrangements kick in, we will have the ability to press the pedal on originations, even in a slightly lower yield segment. Okay, so that is as far as gold loan is concerned. Now, as far as medium ticket loan against property is concerned, our originations have been increasing quarter on quarter, and we seem to have settled in on a sweet spot which optimizes yield, risk and growth for us. Okay, we are able to get all three, at in the cities that we do business in with the product that we sell. So that business has no issues. It should continue to grow, and the trajectory of origination and growth is there on a slide in the deck. Now, as far as unsecured is concerned, the feedback from our portfolio has been similar to the previous year, if not marginally better. Okay. Now, in contrast to whatever the environment is articulating on unsecured performance, our unsecured portfolio has largely held. We are also seeing a lot of interest from banks to purchase our unsecured portfolio. In the first half of the year, we sold down as much as we originated, roughly. Okay, so that business is good, and the origination on that and the growth on that is calibrated by how much we want to keep unsecured as part of our overall AUM. So that's what determines this. Okay. So these three businesses, there are no issues at all. Now the small mortgage business, because of the sheer number of tickets and the spread that this business has, 18 states that we are present in, we are saying that there is no need to double down on growth the way we did last year. Last year we had a near 80% increase in terms of AUM growth. That is not what we are shooting for in the current year. Okay, we are saying that we will be a little more measured and ensure that we get better portfolio outcomes than we did in the past. Evidence of that is the 1+ and 30+ that you are seeing in the deck. We should try and better that in the coming quarter, and that will be a good place to be in. A couple of 100 crores of growth this way or that, we are reasonably sanguine, as far as the unsecured lending business is concerned. Now, equally, we are continuing to invest in the business. We are building 30 new branches in the unsecured loan business because that is not for today, that is for the years to come. So that's how we see growth. Yeah. Also, we started this year with 12,000 crores, 12,100. We are at 14,200. Okay. Now so that's already 40% kind of annualized growth that we are seeing now. Our guidance always has been that we will strive to do 25%, and anything over and above that will be opportunistic. We've been opportunistic because gold has worked well for us, for environmental kind of reasons. Okay, and that is the upside and the advantage of our twin engine model, and which will use to compensate maybe some lower origination in the small mortgage business. Yeah, but overall 30-35% I think is reasonably there for the taking in the current financial year.
Okay. Got it. This is very helpful, sir. Thank you.
Yeah, given that we already finished first 2 quarters and we've done 2,100 crores of growth.
Correct.
So sorry, apparently I said 30 branches in unsecured, 30 branches in small mortgage. Yeah. So I should clarify. Sorry.
Okay, so another 30 branches in second half, typically.
No. Apparently, when I spoke in my commentary, I said 30 branches in unsecured. Okay, I misspoke. I said 30. We are opening 30 branches in the small mortgage business.
Got it. No, so this is over and above 40+ branches what we added this quarter, right? Or
yeah, we added 46 in the quarter gone by.
Right.
Okay, our total our target for the year is 80. So 80 minus 46 is 34.
Okay. So got it. Okay. Thank you, sir. Understood.
Thank you.
Thank you for that question, sir. The next question is from the line of Sneha Ganatra from Star Union. Please go ahead, ma'am.
Hello. Yeah. Regarding this, just wanted to know your thought on this, basically on the margin in the cost of funds. Just wanted, because as credit rating is upgraded, so are we seeing that the cost of funds are expected to be peak out from here on? How do you see the second half of the cost of funds, and basically on the margin that can you guide us? And second question is what are the OPEX that we are planning for additional 40 branches and additional overall 80 branches and additional 40 branches are expected to come. So what are the core benefit when we expect that the cost to income benefit that could be that we get income?
Ms. Neha, we can't hear you. Can you please?
Yeah. First question is just wanted to know your thought. How is the cost of funds to be panning out? Are we seeing the peak in the cost of funds considering the rating agency have upgraded? And second question is how do we see overall OPEX to be panning out, and when do you expect that operating leverage benefit that will occur in the upcoming quarters?
Okay. So I'll request Ganesh to answer question 1 on our cost of funds and what we anticipate will happen in H2.
Thank you, Sneha, for the question. I think it is fair to say that I don't have a good answer for that, because we have been hopeful that RBI will mirror what the Fed is doing, but it will happen when it happens. Till then, the money market continues to be tight, lending rates continue to be high. So Q3, we have been, I think, will the cost of funds be lower than Q2? I don't think so. Okay, so Q4 is a different game. So based on what happens in the December policy, we may see a calibration. So I think we should not prejudge RBI. We will watch it every 2 months depending on how the RBI policy spans out. But at least for now, it seems reasonably clear that in Q3 we may, at best be steady or maybe a little higher on the cost of funds than lower. Now the second question was in terms of operating leverage. I'll pass it on to Anil.
So your second, like I said, we are opening 80 branches in the course of the year. We finished with opening 46, and the remainder we have either opened in October or should finish, by the end of November. Now opening branches is a bit like going to the gym. Yeah, you wish you had done it in the morning, so that the rest of the day is good. Okay, but it's not fun when you do it. In our gold loan trajectory this year, there was a huge tailwind in terms of the price of the gold, and our AUM per branch increased quite dramatically last year from about 7.5 crores to 10 crores or so. Now, what we wish this year was that instead of 430 branches, we should have had 600 branches or 700 branches. That was our wish. But then the time to have opened this was 2 years ago when it wasn't. It would have hit our P&L then. So that's just how it is. Now we opened branches. Out of these 80 branches, 50 are for gold, 30 are for small mortgage. The small mortgage branches, between opening, staffing, and achieving some level of maturity, is a 15 to 18 months time frame. Our thinking is that instead of tanking up on growth in specific years, it should be a gently calibrated branch opening kind of strategy. That is the idea. Now, in terms of approach, what we are seeing is that we will try and do it in a way that it least impacts our cost to income, which means we are not adding any senior cost, any supervisory cost, but we are adding branches in regions that we are already present in, which is why our headline of 18 states and union territories hasn't changed for at least almost a year now. So we are adding branches. The area manager and the business head and the regional manager all exist. So we will at least add only production staff, and that should translate into origination very quickly and give us slightly better P&L outcomes.
Okay, and one more question. Once you mentioned the stress, are we witnessing any geography specific stress are we witnessing, or it has been across only?
The stress is actually segment specific. Yeah, we are seeing people are paying mortgage loans at what was a 50% installment to income ratio, or at over 2 years. Now, normally what happens is that the installment to income ratio declines because the installment stays the same and the income increases, let's say nominally by 10% every year, which is your inflation. Now, what is happening is that the inflation that is hitting the poor, this segment is far in excess of nominal inflation. So therefore, the 50% that they had, to repay the loan is now, let's say, less than 50% of the overall income. Structurally, that is what is happening. And this is what I pieced together from, interactions with our field force and all that. Okay. So that's the way I see it.
Okay. Because already we have achieved a strong set of the numbers. We would be continuing guidance of a 25%. We won't like to revise our guidance upwards.
Sorry, if I can ask you to repeat the question and, from a bit further away from the phone, yeah?
Yeah, just wanted to know, already they have achieved a strong set of numbers on the growth front, and we won't be planning to revise our growth guidance about 25% plus for the next fiscal also?
The next fiscal is 6 months away. So I think when I say 25%, that is on a medium term basis. Okay, we've had a good 6 months and we have overshot that guidance. That is correct. But equally, we should be conscious that not every quarter will be like this. The price of gold can come down sometimes, or there may be some competitive